Phyllis here, and I want to tell you about an important topic that you need to know about. Subject to. Many of you have heard that term bounced around and you may not understand what it means. What it means is you're taking the property from the seller subject to the existing mortgage. It is not being paid off and you are not assuming it. What you're going to do is just make the payments yourself. So what happens is the seller deeds the property to you or your trust or your LLC. Don't advise taking things in your own name. And then you're going to continue paying the bank. Now, the way this works is that if you can get a payment that is higher from the next person who's going to be there, then you have to pay the bank. You have a good way to make a monthly cash flow. You could also use it as a way, if you're buying it below market, which you have to do in order to flip it, and then just rehab it and sell it. But in the meantime, you don't have to go for a hard money loan. There's no monthly payments, because what I normally do is give the seller a down payment, and then it's one lump sum when I fix the property and resell it. That saves you a lot of money. In fact, I would definitely pay more for a property under this term than if I had to go for a hard money lender. Then there's no crummy paperwork, there's no monthly payments, there's no points, there's no nothing. So it is the best way to do things. So what you have to do is make sure that it's full disclosure to the seller. In fact, I have a paper that I make the seller sign so that they understand exactly what I'm doing. You do not want to deceive me. Everybody has to be on the same page, that they know exactly what you're doing, and in writing, because people will remember things the way they want to remember and not what you told them. So the question is, do I tell the bank what I'm doing? Well, there's two schools of thought. Some people do not do that, and some people do. They send the letter to the bank telling them exactly what's happening and giving them a certain amount of time to object. And then if they don't object, it's tacit approval of what you're doing is okay with them. Now, the way I explain this to the seller is, suppose you have a husband and wife who buy a house together. They're both on the loan and they're both on the title. They get divorced. Typically, the husband moves out, deeds his part of the house to the wife, who stays there and makes the mortgage payments. He is still on the loan. He's still on the hook until she either refinances or sells it, and hopes that she's making the payments. That's how I explain it to the seller. Now, who's going to do this? A seller who has no other choice. Anybody who's good credit and not in trouble is not doing that. You have to suggest another solution for them, probably at least with an option. But a lot of people, they have no other choice. Whatever. Their credit is already ruined anyway, and it's a better option than having a foreclosure on the record, which screws the credit for years and years and years. It's even better than a short sale. Because basically, if you're making the payments in their name, you're improving their credit. So it's good. It's a win-win all around. So make sure you understand, and the seller understands, that he has to leave. You're going to go through a regular escrow, get title insurance anyway, but the bank is not part of. You don't call for a payoff. You have to find out what it is on your own. So hopefully that you can use this little tip and make some money. This is a really great time to invest. I'm getting deals thrown at me left and right.